what is debt to income and why is it important? Well, your debt to income is just that. It's a ratio. It's a comparison between the amount of debt you have compared to the amount of gross income you have. And there's two different ways we calculate it. So first you have just your housing debt to income, right? So this is your housing debt, the amount of money you pay every single month on housing. And what we mean by that is principal and interest on a mortgage, your real estate taxes, your homeowner's insurance, any other mortgage insurance or any other type of insurances like flood, plus your homeowners association dues, so your HOA dues, and any other of those payment buckets. We take that total and then divide it by your gross income. Okay, that creates your what we call a front end ratio or your housing expense ratio. Typically, you're going to want this to be ideally in the 20s or 30%. So you would want 20 or 30% of your gross income. Remember, gross income, it's gross because it's gross how much taxes they get taken out to create your net income. Okay, your gross income is before anything's taken out. So when you're creating your budget, you want to think about that. We're going to qualify you based on gross, but you live off your net. Okay, so front end ratio, that's your housing expense ratio. That should be ideally 20s or 30s to make sure we're not extenuating your ability to repay the loan. Now, then you have your total expense ratio. Your total expense ratio, that's going to be all of the debt that shows up on your credit report, all your monthly liabilities that you're obligated to repay. Credit cards, car loans, student loans including those that are on forbearance or deferment. We still have to, depending on the loan program, there are still a chance we have to include some sort of payment in your total housing ratio, okay? But car loans, credit card bills, any type of installment loan, any additional mortgages you might have on any additional houses, those housing expenses. If you are a guarantor on a note that doesn't show up on your credit report, we're going to need that as well. So anything you're obligated to repay every single month, okay, not your utilities, not your food, just those things you're obligated to repay, get calculated in your total housing expense ratio along with the new mortgage payment. So we add all that up and divide that by your gross monthly income, and that creates what we call your back end ratio. Now, these two things live in harmony. It's not just one that we look at. So if your lender is having a hard time getting you approved, maybe if you paid off some debt, that could actually increase your chances. However, if your mortgage payment, if your new mortgage payment is going to be really high and take up a lot of your gross monthly income, you still might have some challenges in getting approved. Doesn't mean it's not going to happen, but you may see some challenges. That's why it's important to work with an expert who understands the dynamics between the two ratios and how they work to maximize your buying potential to stay within your budget. Again, if you have additional questions, feel free to put them in the comments. Don't forget to like and subscribe to my channel. Want further information, you can always shoot me a DM. Thanks.